Welcome, ladies and gentlemen. Thank you for taking the time out of your self-isolation to be with us. We're used to doing these things face-to-face, but I definitely think that it seems as though online meetings are going to be the new normal for a little while. Today I'm going to share with you some data on COVID-19 and how we believe that this is going to affect the Australian property market, both commercial and residential. My name's Jay Pace. I'm one of the directors of a nationwide buyers agency and research firm known as Providence Property Group. Now, for those of you who are unfamiliar with how a buyer's agent actually adds value, I'll quickly take you through it. Instead of taking on the monumental and often risky journey of buying property by yourself, Providence will act as your representative and expert consultant, if you will, when it comes to buying a property. And we focus on three main areas here. Now, we focus on locating your ideal property, both on and off market. On market is obviously what you see on realestate.com, Domain, etc. Off market are properties that usually you won't be able to find on public forums, and they're usually the result of years and years of strategic partnerships and alliances. So we look at off market opportunities as well. Now we look at the state, the city, the suburb, the street, and the structure. And then we move on to the second part, which is the assessment period. And this is when we assess the pros and cons of a property, build quality. We look at things like owner-occupier appeal, layout, use of space, supply and demand, distance to amenities, etc. It's a pretty long list. Now then we look at negotiating for the best price on the most attractive terms. And Providence uses the latest research and technology to save Australians time, money, and stress. And before the end of today, I'm actually going to show you some of that research. Now, our objective once you engage Providence is we want to make sure that we purchase your ideal property at the optimum time for the best price. Now, we all know that knowledge is power, but unfortunately in Australia, we spend way too much time searching and very little time researching, and that ends up costing us a lot of money at the end. Now, it's been 4 weeks. The 23rd of March actually was when the government shut down non-essential services, and they placed a temporary ban on auctions and open inspections, and essentially they halted the economy in response to COVID-19. Now, it's important to remember that this is not a financial downturn. Okay? We are in a health crisis which is resulting in productivity challenges. I'm not downplaying the severity of the situation anyway. I'm just calling it for what it actually is here. There's plenty of businesses and plenty of clients that we have businesses that are very healthy and were doing very, very well before the government told them you can't do this anymore. And I feel sorry for those businesses at the moment. I really do. Now, I commend our government, though, at the end of the day for their quick and significant response to this pandemic. Never in my lifetime have I seen such cooperation between, governments, councils, political parties, and industry bodies. So good on them for doing this. Now, for those of us with short-term memory loss, we have been in this situation before, quite a few times actually, and there have been many global outbreaks and pandemics of viruses like bird flu, swine flu, SARS, MERS, Ebola, Zika virus, etc. Now this is a history of pandemics. It's a visual history of pandemics, and the yellow highlighted sections show that from 2002 to 2016, pandemics claimed over 215,000 lives. Now, historically, during previous global crises and global outbreaks of illness, the Australian property markets actually remained quite resilient. Now, I'm going to show you plenty of data today which supports that claim, but this, however, is the first global crisis that we've ever experienced, and that's anybody, that's been in the social media age. And we've learned two things from this. One, information spreads incredibly fast. Two, false or sensational information spreads even faster. Now, this graph was updated this morning, the 21st of April, and it shows the total reported cases of COVID-19 across Australia. They're currently 6,636, and the total reported deaths here are 71. Now, this chart represents confirmed cases across the world, and that includes our Australian states as well. And forecasting the virus's global peak is fundamental to determining the time that it's going to take us to return to a state of normality or whatever the new normal is going to be. Now, governments have suggested a minimum 6-month time frame for this virus to be considered under control. Now, it's believed that this will only be achieved under a very strict adherence to stage 2 and stage 3 lockdown guidelines, and the most important of which is going to be social distancing. Now, our view is that 6 months of lockdown is not sustainable. It's just not. Staying at home doesn't agree with everybody. Anyone that has children definitely during the Easter holiday, which we're currently in right now, knows exactly what I'm talking about. Living under strict shutdown measures could lead to some very serious social issues. And in a worst case scenario, civil disobedience or even protests. And we're already starting to see that in places like Brazil and the United States. Now, looking at the Australian confirmed cases graph that's right here in front of you, it's very obvious to us that we reached the virus's peak on the 28th of March. All right, we've now flattened the curve, and it appears that we actually have COVID-19 under control. Australia currently leads the Western world with the lowest amount of confirmed cases, the highest number of tests per 1,000 people, and we also have the lowest fatality rate of infected patients. Now, we believe that the government, intentionally and successfully, might I add, created enough fear to force the extreme actions that were required to get COVID-19 under control. Now, based on our current position, we can seriously consider the possibility of slow-staged easing of lockdown measures probably sometime in June, all right? With Australians mostly all back to business under a new normal, whatever that's going to look like, by the third quarter of this year. So that's still going to be under strict social distancing, which is going to be enforced, I would assume. And I would also assume that we're going to have controlled movement throughout our borders during that time as well. Now, I would be very surprised if international borders open up within 6 months. I think it's going to be a little bit longer than that. Now, when we compare this financial response that we're currently doing now to other G20 countries, Australia's fiscal policy puts us in a very strong position to ride out the COVID-19 storm. And this table shows that compared to other developed countries, Australia's stimulus package as a percentage of GDP, our gross domestic product, it's on the higher end, and we are above the United States, above Canada, and significantly higher than our neighbours in New Zealand. Now, this chart shows 2 decades of Commonwealth spending, and this is both past and forecast. And this includes stimulus packages, which are in the orange there that you can see. And when we compare the government's GFC response to their COVID-19 response, we get a really clear picture here of just how committed that the government is to getting Australia through this. Now, during the GFC, Australia was one of only 3 developed nations to avoid going through recession. Now, many are going to say that, well, that's because, we are the land of natural resources, and I would definitely agree with them. But from 2008 to 2011, the government spent about $51 billion on stimulus. Now, the current numbers show a committed stimulus of almost $200 billion, with potentially further stimulus to follow. So these stimulus packages are essential to ensuring that we're in the best position possible to rebuild and re-employ in the hardest hit industries when the shutdown measures start to ease. And that's most likely going to be in the third quarter of 2020. Now, I want you to ask yourself something. Where do you think the hundreds of billions of dollars that the government's currently printing, where do you think that's going to go? Well, we believe that a large percentage of that money will be capitalized into property prices in the long term. It always does. And I'm going to give you some examples. Now, here's a chart displaying Australia's quarterly GDP growth. And I've circled our 1991 recession in red. Now, I'm showing you this because the main question on everyone's lips is, what will happen to property? Well, we only have to look to history for that answer. And history shows us that despite global crises such as the GFC, the 1991 recession, the 1987 stock market crash, and outbreaks of illnesses such as SARS, Ebola, the Australian property market has actually remained quite resilient. And in fact, if you look there, following the 1991 recession and the tech wreck of 2001, or the .com crash as they call it, the Australian property market boomed. And that was due to its reliability. Now, if we compare where we are today to our last recession, our property market is certainly higher. In fact, over the last 25 years, this chart shows you up to 2018, Australian dwelling values have actually increased by an average of 6.4% per annum. Now, that's a significant increase. Now, these charts that I'm going to show you now show you the housing indices versus the All Ords index across previous economic shocks. Now, property's in blue and yellow is stock. And the dotted line that you can see there in the middle, that's the 5-year point on either side of that catalyst of the event. And here's the stock market crash of 1987, the Asian financial crisis of 1997, the tech wreck or the dot-com bubble, whatever you want to call it, of 2001. Now, that was $5 trillion in stock market losses. And look at the roller coaster ride that is the share market. And look at the consistency of the trajectory of property. Now, it's not a straight line, but I know where I'd rather have my money during that time. And we've already seen stock markets plummet more than 30% in less than the first 2 weeks amid the COVID-19 panic. Now, still fresh in my mind is the GFC. And I remember, watching it on Sky Business News and people walking out of Lehman Brothers with cardboard boxes. And the Dow Jones sustained $1.4 trillion in losses in the first 5 days. Now, that's the largest 1-week loss in New York Stock Exchange history. And you might be wondering, well, why is property not as volatile? Well, it's pretty simple. Selling property is not as easy as selling a stock. You can't just pull out your phone, open up an app and press a sell button. It takes weeks to get property ready for sale. So there will be less impulsive property sales, which will avoid a mass sell-off. And unlike what we've seen on global stock markets, it should relatively remain quite calm. All right, we are going to see some great opportunities, but not a sell-off. And the one thing that 25 million Australians have in common is the need for shelter. So research does suggest that a strong property market will again, as it has time and time before, lead Australia out of the latest health crisis, recession, etc. And potentially that's going to start as soon as 6 months. So when will we see a rebound? Well, this chart here shows you the home value index from CoreLogic and its growth rate over the past 25 years. Now, the dark columns there that you can see represent crises throughout the decades. And by analyzing this chart, it shows us that home values have been relatively insulated from economic shocks. But where we have seen them react the most has been to credit tightening events. And the most recent example, and everyone should remember this, it was only a little while ago, this was the 2017 Royal Commission, which resulted in a tightening of lending by APRA. And we saw the Sydney property market actually retract in price by an average around 16%, and that was just in 12 months. As always, though, this contraction of price was pretty short-lived, and the data from as recently as March 2020 showed that the Sydney property market was less than 3% off returning to its 2017 peak. And you can see that there in that chart where APRA started clamping down on tightening in the top left-hand corner, that yellow circle. We had that decline, and then around December 2018, we started seeing the market pump up again, and it pumped really, really hard during 2019. Now, we're not worried about credit tightening, okay? There's currently an unprecedented amount of liquidity being injected across the globe at levels that far surpass the post-GFC measures. And we believe that this crisis will be short-lived and we will bounce back faster than we did during the GFC. By mid-2021, most countries are going to return to free movement of people, and we do believe that's going to be post-vaccine. We are going to get infrastructure delivery that's going to be fast-tracked. Jobs are going to rebound across all sectors, and the virus is no longer going to really be a threat. All right, we will see positive improvements in asset values, so stocks, but definitely none more than those underpinned by land. So if I sound confident, it's because I am. All right, this has been the case for every crisis and cycle that has existed prior to this one over hundreds of years, and we expect that this current crisis is laying the foundation for an even stronger real estate cycle from mid-2021 to 2024. And that should be the second upswing that we see in this particular cycle that we're in. If you don't know much about property cycles, we've got a great video on it on YouTube. Go on there, Providence Property Group, check it out. Now, let's talk about how this is going to affect us today. Let me go on record here. I believe that in a year from now, and in particular 5 years from now, and most certainly 10 years from now, this pandemic is going to have zero influence on where the Australian property market is going to end up. And the entire Australian property market is not interlocked, all right? It's markets within markets. And the first properties that get affected by economic turbulence have always been those located in lifestyle, holiday, regional, and mining areas. Providence does not recommend investing in these areas. Now, outside of those just mentioned, it's likely that the more expensive and top end of the property market is going to be the hardest hit. And I've listed the top 10 most expensive suburbs in Australia with houses on the left, units on the right. Now in Sydney, you've got your eastern suburbs, you've got Darling Point, Vaucluse, Double Bay. On the North Shore, you've got Manly, Seaforth, Dover Heights. Historically, these higher end markets drop in value when the stock market crashes. Now, the cheaper blue-collar suburbs where the local workers can't perform their jobs remotely and where there is a higher incidence of casual employment, now they're likely also to suffer significant price drops. And blue-collar suburbs are definitely mainly identified from the census based upon the category of work that they're doing. Now, some of these suburbs throughout Melbourne and Sydney include Miller, Barong, Oakley, Campbellfield, and Sadler. And the top three areas of Greater Sydney with the highest blue-collar populations are the Liverpool area, so Ashcroft, Busby, Miller. There's 51.6% blue-collar. Cabramatta, Lansvale area, that's 51.4%. Bidwell, Emerton, that's 50.4%. That's around the Mount Druitt area. So those are the areas that you'd be focusing on to see those type of falls in pricing. Now, we believe that well-located homes in established middle ring suburbs are likely to hold their value better. And suburbs like Bexley, Ashfield, Kensington, Marrickville, Coogee, don't freak out if your suburb's not on this list. These middle ring suburbs all share these particular characteristics. Now, they're usually around 18 kilometres from the CBD as a radius. They exceed the Australian median household income, which based on the last census was $116,000. They have a good or above average demand-supply ratio score. They've got a population that exceeds 6,500, and they're very walkable. They've got a walk score of 70 plus if you go to walkscore.com. Now, we believe that the initial reaction of panic from COVID-19 has relaxed, and the market's uncertainty has definitely weeded out uncommitted buyers and sellers. And I can tell you from experience, this makes participating in a market much more pleasurable and more efficient. For buyers, if you're taking the time to pre-organize a private inspection and attend an open home, well, you're a pretty serious buyer then. Buyers who had the intention of buying either late last year or let's even say early this year, but continue to be priced out of the market, they're coming back with hope in their eyes. They're hoping that they can get a discount, knowing that the seller who's got this property on the market, they're serious about transacting. Okay, and that's just changing the mindset of these buyers. Now, for sellers, we're seeing sellers who had aspirations of, big prices and a seller's market mindset from 3 to 6 months ago. They're realizing that we're now in a buyer's market. The tables are turned a little bit here. So prospective sellers are now aware of the conditions that we're currently in, and they're entering the market with lower expectations. They're discounting pricing, and they've got a flexible mindset. Now, depending on your idea of value, the pricing on most of the homes that we're seeing has dropped between 5 to 20%. Okay, that's on where it was a month ago. And that changes across different price points, styles, and locations. Now, this chart shows the amount of new listings. Okay, 2020 is in the orange at the bottom left-hand corner. It's obvious that those who don't actually have to sell at the moment are staying out of this market. That's why volumes have dropped so much. And we're seeing new listing numbers are tracking lower than they were a year ago, and they're likely to continue falling for the coming months. I don't want you, though, to make the mistake that everyone selling at the moment is desperate. Don't think that. Our agents on the ground believe that the majority of those selling at the moment are not distressed sellers. Remember, the government only shut us down 4 weeks ago. That means they moved really quick to sell their properties, which means they were already distressed if that's the case. But the majority that we're seeing, their main driver for selling their properties is that it's lifestyle. People are trading out or they're trading up. And you might think that's silly, but if you're selling a property that was worth $1 million before and you're selling it for a 10% discount, you're losing $100,000. But if you're moving up to purchasing a $2 million property, just keep round numbers, you're getting a $200,000 discount. So you're actually still in front by $100K. So selling out to buy up makes a lot of sense at the moment. So you might be purchasing a superior asset, you might be reducing your risk, your exposure, lowering your debt, offloading for tax reasons. We get lots of clients that hit a 6-year threshold and they have a CGT claim and they just want to get rid of it so they don't have to be charged capital gains tax. They might be cutting ties for relationship reasons. They might be getting divorced. You don't know. So for buyers, their upcoming challenge here is definitely going to be at lower stock levels. That's going to be the issue. And this is always a frustration for active and committed buyers. It's a hopeless feeling when you're scrolling through properties on an app and the list is very short. So as the nationwide shutdown continues, we do believe that during the next 3 months, we're going to see a surge of properties just sporadically, just randomly, every now and then, depending on how people are holding on, of people offloading investment properties and holiday homes. So they're not going to be able to financially support them. They're going to have to get rid of them. They're going to drop pricing. Now, this chart shows the direction of national gross rental yields, and it's trending down. Historically, we see sharp increases in rental yields in the aftermath of a financial crisis. And this is because buyers they're more cautious and many postpone their plans to purchase a home. And this leads to an increase in renters, all right, more renters, because in the aftermath of the GFC, Providence was purchasing distressed properties in Sydney with rental yields that average 5.8%, some above 6%. So we definitely think that that's what's going to happen again. You're going to see a drop and then you're going to see a sharp jump. Now, we can see from this chart that the percentage of properties sold at auction at the moment is, prior to auction at the moment is the highest it's ever been. All right. And many auctions are being withdrawn. So 66% of properties sold at the moment are being sold before auction. Now, this clearly indicates that sellers are open to negotiation. So make sure you study up, you know what to offer, you understand what a 66W is, how to waive cooling off periods, etc. There's a lot of things that you can use in terms to get you that better price. Now, we've been buying well for our clients in the current marketplace, and I've only got time here to give you one example. There's plenty on our website, so please go and have a look at providenceproperty.com.au. But what I wanted to show you here is what we're achieving on the streets. Now, we identified this beautiful, fully renovated 1850s character home for our client 2 weeks ago. And the client came to Providence exhausted and understandably very frustrated because they'd failed to secure their ideal home and they'd been looking for over 14 months. Now, it takes the average Australian about 9 months, according to Domain, to locate, assess, and negotiate a property. So this person was way past that. Providence attended auction on the client's behalf, and it was passed in. Now, we were the highest bidder. And stamina was definitely required by the team here because after a 9 a.m. auction, we started negotiating. And we negotiated to exchange a contract with the vendor, with the seller, at 11:44 p.m. that evening. Now, we secured the property for $1,555,000. Now, this was $145,000 below the auction day reserve. And critical to the success of this purchase was extracting crucial information from the agent regarding the vendor's current situation. This included facts like they'd already bought somewhere else, so they needed to sell ASAP. So getting that information was obviously crucial to our success. Our buyers thrilled. They're so happy with the purchase. They have a long-term view. If they get a little bit of a dip afterwards, they don't mind. They know they already got it at a discount. Now, let's talk about commercial property market for a moment. We're seeing falling valuations and an oversupply of office space in CBD markets. Now, this is not a healthy diagnosis for the commercial property sector. Disruptions to trading conditions and the impact of rental flow is already and will continue to hurt commercial property for, let's say, the next 6 months. Now, a fall in valuations could definitely create some serious headaches for highly geared investors, but it's also going to create some once-in-a-lifetime purchasing opportunities for street-smart investors. And we always tell our clients, you make your money in a boom, but you build your empire in a downturn. We're here to help people build those empires. Now, 2020 is a big year for commercial space. This chart shows the expected percentage increase in delivered commercial square meterage space in both middle ring and inner city suburbs, inner city Sydney and Melbourne. Now in Melbourne, and these numbers are just crazy, in Melbourne nearly 400,000 square meters of supply is expected to be delivered by December. Now that's the largest increase in commercial space in 3 decades. Now the Sydney market, a little bit less, is expecting 150,000 square meters to be added by December. So Providence does purchase commercial property for many of our clients, and we've been very successful with it. They're a great yield tool, but we do not recommend retail commercial real estate. There's just high vacancy risk there, and that's because there's weak consumer spending and there's a heightened competition in that market. So for us, we just tell our clients to steer clear. There's other commercial assets that you can purchase in property that are better than retail. Now, it's important when buying commercial during this particular environment that you do as much research as possible on the tenant, okay? And that's to avoid a situation where you've got no tenant and you've got no income. Now, I want to finish up here by giving you some of my final thoughts. Firstly, this is a once-in-a-lifetime buyer's market. You could grab a 5 to 20% discount on your purchase at the moment, which is what we're seeing. We are now in a buyer's market, and as buyers, you have transitioned from a price taker to a price maker, and it is the ideal market environment for strong price negotiation. Now, money has never been cheaper, and we have the lowest interest rates in history, and a promise from the RBA that they're not going to raise rates until unemployment reaches more ideal levels. This is very important. Don't panic if you have exposure to property already. Okay, I know I'm talking about great opportunities for buying here, but if you don't have to sell, don't worry about it. This is a short-term market devaluation, and property, which was purchased with a long-term view, will thrive. Approvals and property building commencements have shrunk, and they're going to continue to decline, causing enormous undersupply. Now, new supply was already tight as a result of the Royal Commission in 2017, and the tightening of credit, which also followed that. Now, these conditions are ideal for prices to rise once we get through COVID-19. And rental vacancy rates, they've been trending downwards in recent years, and this will further this further undersupply is going to put intense upwards pressure on those rents. Now, the demand for property will increase as Australia looks for a less volatile investment. I remember when the GFC happened, we had a significant amount of self-managed super funds being open, and that's because people were just so disheartened by seeing their hard-earned money get lost in the stock market, and they opened up SMSFs and they purchased property in there, and we believe that's going to support this market again. And history has shown us that property in the right areas bounces back after a stock market crash. So for us, some of the best buying that we've ever seen happened during or shortly after the GFC. So this is the time when fortunes will be made. And I'm not saying that you should be impulsive and just go out there and buy something. You need to do your research. All right. Very few people, though, pick the bottom of the market. Do not be that person that sits there and goes, I'm going to wait for it to keep falling. Because you're going to be the same person that said that after the GFC. You're going to be the same person that missed out on the 2011 to 27 run. You're going to keep missing out, okay? We don't know when the bottom of the market's going to be, but we do know that we are buying well for our clients at the current point in time, okay? So make sure you're at least looking at the market and you're in a position to jump on something if the opportunity rises. Now, I'm just going to sign off, but we've got a ton of videos on YouTube with tips, tricks, and research. I encourage you to use this for your own self-education. Remember, procrastination and fear comes from lack of knowledge. In order for you to take action, you need confidence, and confidence comes from knowledge. The property cycle, it's very predictable, and Providence is known for its description and its predictions based on our understanding of that cycle. So if you'd like to watch a full video on the cycle, type Providence Property Group into YouTube. Check those out. We've got videos on challenges facing retirement, which for, some of those people that are obviously in their 40s, getting into their 50s, retirement's a big thing you've got to think about. Lastly, knowing when to buy and when to sell. It's not worth much if you don't know where. So we've got a 3-tier research methodology, which has allowed us to return above average results for our clients for over 14 years. And if you'd like a sneak peek at our purchasing criteria again, well, I recommend that you go to YouTube. Just type in Providence Property Group, check it out, or go to our website. Thank you so much for taking the time to listen to the data and what I had to go through. I hope it's been beneficial. I hope it's been educational, and I wish you the best of luck with your purchasing. If you have any questions or you would like some assistance, contact Providence Property Group today.